Welcome to Phillip Futures Weekly Market Watch. I'm Han Qiang, investment analyst from Phillip Futures research team. Today, we are going to look at the economic outlook for India. In September, India unveiled plans to liberalize foreign direct investment in sectors like multi-brand retail, aviation, and broadcasting. This is a clear indication that she is determined to revive the slowing economy. This is a chart showing India sector limits revision. The government allows foreign retailers to own up to 51% of multi-brand operation in India from 0% previously. This move allows international supermarkets into the country. Overseas airlines can hold up to 49% in India carriers from 0% previously. Foreign investment ceiling for cable and satellite TV operator is raised from 49% to 74%. Although the effort to reform her economy is encouraging, it is too early to evaluate the effectiveness of this policy because a backlash from opposition parties is expected. The last raise in diesel prices and the last reform on retail sector will reverse due to intense opposition. This is a chart of India gross domestic product year-on-year percentage change. India economic activities in the first quarter of 2012 grew by 5.5%. This is well below the strong performance of recent years, as you can see from the chart. The decline began in 2011, which saw a notable deceleration in each successive quarter. International Monetary Fund released World Economic Outlook publication early this week. IMF forecasted economic growth of 4.9% in India for 2012. This latest forecast is a downward revision of 1.3% from a similar forecast which the organization made in July 2012. India is suffering from falling business confidence as political skirmishes delay approval for new projects and impede structural reforms. Eurozone debt crisis also contributed to her weak external demand. Although the recent reforms will have some impact, it will likely take some time. The latest reforms are projected to raise GDP growth to about 6% in next year, according to the same IMF report. This implies that India will have to endure sub-5% growth for some time, leading to rising unemployment among young people who are joining the workforce in the millions each year. In September, India also raised the prices of diesel by 14% in an effort to cut back on subsidies and to bring her fiscal deficit under control. This will likely have an adverse effect on inflation, which will remain stubbornly close to 10% in 2010 and 2011. This year, inflation as measured by wholesale price index stabilized near 8%, as you can observe from this chart. The persistence of high inflationary pressure was largely due to high food prices, which, after dipping briefly for 2 months in December 2011 and January 2012, reverted back. Current inflation in India is high and remains a stumbling block for easy fiscal and monetary policies. Moreover, the government is suffering from a current account deficit of 4.2% of GDP in 2011, an all-time high, constraining her option of using easing policies to stimulate the economy. This is a chart of India's current account as a percentage of GDP. High oil prices along with large gold purchases widened trade deficit to 10.2% of a GDP. The large trade deficit left the current account deficit at an all-time high of 4.7% of a GDP in June 2012. The first quarter this year also saw very weak capital inflows. Both foreign direct investment and portfolio investment are just a fraction of previous quarters. A widening current account deficit, weak capital flows, and deteriorating global economy put significant downward pressure on Indian rupee, which depreciated by 14% against the US dollar from its peak in 2011. In conclusion, in line with the economic data presented, outlook for India's economy and her currency remain poor. This is the end of my presentation. Thank you. Tune in to next week Market Watch.